Good afternoon. Welcome to the Committee on Public Finance. We are privileged to have the entire governing board and the monetary policy board, as well as the deputy governors and other relevant officials. Up to the deputy governors is by law. They have to be present. Mr. Govindasamy, there is a seat in front. I wanted the governing board to sit in front. He's not coming. By designation, that you be heard by us once every 4 months. So today we are doing that. That's based on 80 subsection 2 of your act, and also we have meeting to hear your explanation on 26 subsection 5, which says if the central bank misses the inflation target up or down 2 quarters, that you should explain to the House as to why that is and what remedial measures you are taking to ensure that it falls within the legally accepted band. So that's our objective today. What we'll do is we will take the 26.2 first, and then you can explain technically why what happened with the inflation target, why did you miss it, and so on, what action you have taken, and then we'll go to the 80 subsection 2, which is a more broader discussion on what's going on. Is that okay, Governor? Then before we start, would you be so kind to introduce yourselves for the record? Dr.
I'm Professor Priyanka Dumsingha, Monetary Board member.
Ravi Ratnayaka, member of the Governing Board and Monetary Policy Board.
Nandalal Virasinghe, Governor, Central Bank of Sri Lanka.
Vish Govindasamy, appointed member of the Governing Board.
Mihal Fonseca, appointed member Governing Board and Monetary Policy Board.
Senior Deputy Governor and member of the Monetary Policy Board.
Rajiv Amarasuriya, member of the Governing Board and Monetary Policy Board.
Anushka Vijayasinghe, appointed member, Governing Board and Monetary Policy Board.
Manil Jayasinghe, member of the Governing Board and the Monetary Policy Board.
Sujita Jagajeevan, Director of Economic Research.
JPR Karunaratne, Deputy Governor and the member of Monetary Board.
Dushni Virkon, appointed member, Monetary Policy Board.
Chandranath Amarasekara, Assistant Governor and the Secretary to the Monetary Policy Board.
Chamindu Bandara, Assistant Governor.
Dimuthu Samarathunga, Assistant Governor and Secretary to the Governing Board.
Enoka Mohotti, Assistant Governor.
Lasita Patberia, Additional Director, Economic Research.
Chanuri Jayasinghe, Director, Non-Bank Supervision.
Erandhi Liyanage, Secretary to the Governor.
Hemantha Ekanayaka, Director, Communications.
Inoka Vikramasinghe, Director, Legal. I'm Rukshana Jayathilaka, Director of Bank Supervision.
I'm Prabhat, Director of Human Resources.
Thank you. And to those are members who came in late and officials, today I made an announcement in the House that you were expected and that any member who wished to participate in this as observers were welcome. So we have a few requests and I've asked them to come join our committee today. Yes. Governor, you want to explain why you missed the inflation target?
Yeah, I think we have shared the document that we submit to the Parliament as well as a brief presentation just to briefly explain in the reasons in the detailed report that we already submitted. So I think I would like, if time permits, with your permission, Honorable Chairman, ask Director Economic Research to take you through briefly first the presentation, then we can open for discussion. And
Now, while as governor, now this is a bit of a awkward situation because you missed it downwards, right? But the problem is if you miss it upwards. But what is the? You just come here and explain, and then what happens?
we have explained what are the actions we are going to take to come back to the normal our commitment to the targets. So this is explaining what has happened, and then explain the measures that we will be taking to come back to the 5% target. So that's what is required under the law, I think, under section 26.
Governor, for the knowledge purpose, can you briefly explain the economic reasons why there's a ban and why a country should particularly be within that ban, and what is the basis of that?
Yeah, I think this was asked even last time by the Honorable Chairman. The basis to have this new monetary framework, what we call inflation targeting framework. The basis for the inflation targeting framework in any country is to announce mandate to be given to the central bank by the authority, that is the Minister of Finance, under the act, like any other country, give us a mandate. This is what our mandate to maintain inflation at a certain level. So once we have that mandate or target, then our responsibility is to deal with that. So basically, idea here is that the government has a right to decide what is the appropriate level of inflation for the country, based considering all the facts. This is how all the other countries are determining, and what we had earlier under the earlier act, we had set targets by our own without getting the mandate from someone else, from the administration. So new act says we are accountable and responsible to deliver that, so that this is a consultation with the government and the central bank, do a lot of work, what is the appropriate level of inflation for the country. On that basis, we came to agreement and signed a MOU for 3 years for us to maintain inflation around 5%. So that's the basis. I think why 5%, and we can have a technical discussion. A lot of work went into to find out what is the appropriate level of inflation for a country like us at this stage of development. This obviously can be revised going forward at any time with the consultation agreement with two parties, but 5%, I think we look at the several other markets and similar countries in the region, and also especially countries that adopt inflation targeting. What is important to announce a target is to basically anchor inflation expectations among the public and make it transparent. This will be the inflation for a medium to long term for the country, so that any consumption and investment decisions can be made on more certain kind of inflation path in the forward, so that is easier without knowing what the inflation will be in the future. Then it will be difficult and a lot of uncertainty. I think that's the most important economic variable for any investment consumption decision. That's the rationale for honorable member your question. Why we need to have a target.
Yeah, just two questions, Chair. One is that the particular target that we have set, is it within the IMF program that is it inconsistent with that, so that every other variable will kind of need to be adjusted with this particular targeting, right? So this will go as an input variable for many other assumptions and growth projections. So the IMF targets that we have to become sustainable, this inflation is what has been taken, am I right?
Yeah, correct. Basically, I think it's not that IMF condition we need to have a 5% target. This is our own target. Then IMF take it as appropriate inflation for us, and on that basis they have their own basically projection on what is the baseline interest rates, medium long term, then government financing needs, EFN and all these are based on the appropriate real interest rates. So that's the basis for the for other variables. Obviously, it has implications on mainly the financing of both private sector and the government sector.
Yeah, and the last other question is now we had a dip, right, a huge recession, and so when a country coming out of a recession and again stabilizing and going into a growth phase, how did we kind of find a referral country? Or when you said that the team looked at other countries which are similar, so when we say similar, is it a growth pace similarity or a country that comes out of a a recession? Was that considered?
Yeah, I think
or like a hyperinflation to normal. So these are conditions. So if you take a country like us at our growth rate, we can find similar countries. But if you have to find a country which has went into hyperinflation and a recession and then coming out of that kind of a thing, 3-year period, this kind of inflation is something, have we looked at that?
Yeah, I think when we discussed with the government, actually new Central Bank Act was enacted and passed in 2023, I think August, right? September. So 2023 September, by the time inflation had already come down to below 10% level from 70% we had with the crisis. So that's one thing. One other thing is that when we consider what is the appropriate medium to long term inflation, I think the short term shocks and outliers, I think in my view, need to be excluded. We can't have a medium to long term target taking into consideration what was the last 1 year inflation. So we look at basically historically what was the average and how that was comparable with other similar countries, and then on that basis we came to agreement that 5% probably would be the appropriate for the time being. Obviously, I think what happened in other countries, once we move on above the over a period of time, then we can think about whether we need to tighten further to 4%, or it's usually moving towards the lower path. If you look at the countries moving into higher growth path or higher level of standards, then advanced countries around 2%, some are 3-4%, and some are 6%. So I think we need to move in that direction going forward.
Okay, Dr. Jagajeevan, yeah, just one moment, yeah.
On the area that you gave some explanations, the new act still makes you the main aspect of yours is to ensure domestic price stability. Is that correct?
Yeah, correct.
That's your main concern.
Objective, key objective.
Yes, that's only objective that it needs to be achieved. And thereafter, to ensure the secure financial system stability.
Correct.
Now, this section 6 has no reference on section 26(1), which basically where the corrective action be. Your explanations here should be why you have departed from the agreement that you have with the finance minister. The finance minister has wanted a 5% with a rather broad 3 to 7% on either side, and the last 2 quarters you have not been able as a team to achieve that.
Yeah.
It's not only the last 2 quarters, but it seems to be from September up until last January.
Correct.
So on that basis, the policies that you pursue on an independent basis don't seem to be viable, because your anti-inflationary approach alone is not the only solution or not the only panacea for all ills here. Now that has strengthened the rupee, impact on the exporters, and your explanation saying that you all are departed has been because of the rupee has appreciated and other fiscal matters. So we would like to answer exactly as to why the independent central bank, from your monetary policy, where have you departed?
Okay, now
yeah, this is all about the presentation.
Yeah, can we just, Governor, can we move on with the presentation, keeping in mind the honourable members' concern?
Yes, the answer there in the presentation.
Right. Okay, I'll also raise 2 issues when you are presenting. You can think about. One is 5% the correct figure, right? And second one is core inflation or headline inflation that we should target. So those are the 2 points that I want you to keep in mind, Dr. Jagajeevan, when you are presenting. Thank you very much.
But what you say, core inflation means you are taking the full energy price
Yeah, the
out.
volatile ones
So
out.
that's not in realistic terms, no?
No,
Okay,
I mean
if you're
from the-
looking at
no.
year on year, it doesn't matter, but core inflation won't be something.
No, the point here being, central bank is independent. So monetary policy can only influence, in my view, those matters that are not, not highly volatile because of some external shock. Oil prices can go up. There could be food droughts and food prices can go up. But then monetary policy is other things. But monetary policy may not be able to immediately find solutions for those. So I'm just saying, as you explain, keep that in mind so that we can have a discussion on that after the presentation. Thank you. Go ahead.
Good afternoon to the honorable members of the committee. We have put up a few slides to explain, summarize the report that we have submitted to the Parliament. So the presentation will cover key areas, a brief introduction to this requirement under section 26, subsection 5, and reasons for deviations from the inflation target, remedial measures being taken by the central bank, near-term considerations of the central bank, and an estimate of time period within which the inflation is expected to return to the targeted level. If I go through, under the new Central Bank Act, the Central Bank's primary objective is to achieve and maintain domestic price stability. And under this requirement, the Central Bank is expected to sign an agreement with the government that is called Monetary Policy Framework Agreement that is setting the inflation target applicable for Sri Lanka. So this agreement was entered in October 3rd, and that specifies the definition for inflation target to be achieved by the central bank under this section. So the inflation target is defined as the quarterly inflation based on Colombo Consumer Price Index, and that is targeted at 5%. At the same time, there is a definition about inflation target miss, and that target miss has been defined by a margin of plus or minus 2% from the targeted level. So the Act defines that inflation, the central bank is said to have missed the target if for 2 consecutive quarters the quarterly inflation is either below 3% or above 7%. And as per the definition, we have missed the target for 2 consecutive quarters, the second and third quarters of 2024. And the requirement under section 26(5) says that there should be minimum 3 components in this report to be submitted to the Parliament and later to be published to the public. One is the reason for the failure to achieve inflation target. The second, remedial actions proposed to be taken by the central bank, and an estimated time period within which the inflation target shall be achieved. So this graphically shows how this quarterly inflation has moved in the recent times, starting from the quarter that the Act came into place. So we can see that there has been a target miss in quarter 2 and quarter 3, and now we have the data for quarter 4 as well. So that also suggests that the target miss continues in the 4th quarter as well, with the deflation of 1.5% quarterly inflation. And the reason, the first section is about the reason for deviation from the target. So the reason for this target miss has been mainly driven by supply side inflation, and supply side inflation was more benign than we initially anticipated. That's largely contributed by the reduction in energy and transport prices and some moderation in food prices. The major factors contributing to this target miss has been significant electricity tariff reduction in March and July, and continued decline in domestic fuel and LP gas prices, some moderation in selected food items, and also the reduction in water tariff. The first component has contributed the largest portion of this target miss, while other components also have slightly contributed to the lower inflation recorded. And however, the co-inflation, average co-inflation has been quite steady at 3.8% in quarter 2 and quarter 3. And if you look at the reasons for this deviation, we have here shown the decomposition chart categorized based on the major categories in the consumption basket. And it clearly shows from March onwards, the blue bar that shows this category of housing, water, electricity, gas and other fuel, which is the largest component in the basket as well. And that's mainly driven by that category. While some of the transport category also has contributed to this negative inflation, while other components have been showing a small positive contribution. And another factor that contributed to this deviation is continuous appreciation in currency. And during the first 9 months, rupee appreciated by 8.2%. And that appreciation was spilled over to the imported prices, and that also had some second round effect on some prices. So that is also one reason why the inflation has been lower than the targeted level. So even though at the beginning of the year we expected inflation to be relatively higher due to the change in the VAT rate as well as the removal of exemption applicable to certain categories of goods and services, that VAT impact has been partly set off by this impact on supply side factors. And also what we have noticed is some of the change in this value added tax has not been passed through to inflation, and the second round effect of VAT has not been that severe. And here we are showing the category wise headline inflation for the subcategories in the basket, and all major categories have shown a notable disinflation path, with some categories like transport and housing, water, electricity category showing negative year-on-year inflation, while other components is showing a smaller positive number. Here we are showing the heat map. The first bar shows the overall CCPI inflation, and we can see that over the years starting from 2021 April, how this inflation has been moving. We started seeing the pressure on inflation from latter part of 2021. So inflation moved from around 5% range towards touching the double digit level, then gradually picking up to a very high level of, so that very high level is shown by a red color shades. And since then, after peaking in September 2022, the inflation has been recording a gradual dissipation, and the recent times are showing the negative components. And if we see the contributions coming from other sectors or other categories also, we can see that the red part that was observed in mainly the mid of 2022 has been contributed by transport, food inflation, as well as some of other components. And the recent ones, that's the concern at present, is we are showing a very low inflation, and that is shown by a light color shade of blue and light green. And you can see that that is mainly coming from housing, water, electricity category, and also transport category, while food inflation is also moving towards a lower shade, light shade, that's also showing a quite low food inflation. The second section is about remedial actions being taken by the central bank. In general, central banks prioritize demand side pressures mainly. However, they are mindful of the supply side shocks as well, and there are spillovers on other categories and the persistence of inflation, and also the impact of supply side inflation on supply side shocks on inflation expectations. So after inflation has peaked at 2022, we have seen a sharper disinflation path. So that has helped us to start the easing cycle much earlier than anyone expected. So we started the easing cycle from June 2023, And since then, policy interest rates have been reduced by 775 basis points. And in November, there was the latest rate cut has been in November with around 50 basis points cut. And the changes in this monetary policy stance, with the easing monetary policy stance, have been reflected in other market interest rates as well. Here we are showing the changes in key interest rates of the commercial banks as well as government securities yields and the money market rate AWCMR, which is the average weighted cold money rate. That is the operational target of the flexible inflation targeting framework. So during 2023, we have seen 625 basis points cut, 600 basis points cut in 650 basis points cut in policy interest rate. For that, the corresponding changes in other interest rates have been shown here. The largest decline has come in government securities yield with 16 to 18% reduction in 2023, and prime lending rate by 15%, and other commercial bank deposit and lending rates have come down by around 12% during 2023. That reduction in interest rates continued in 2024 as well, and around 3 to 4% reduction was achieved in the commercial bank rates, while 4 to 6% reduction happened in the government securities yield. And the reduction in government securities yield and the prime lending rate continues in 2025 as well. That is a reflection of the latest policy rate cut that was effected in November 2024. And the current rates are shown in the last column. So currently, Treasury bill rates are in the range of below 9%, with 8.12 for 91 day and 8.63 for the 1 year rate. And prime lending rate is staying around 8.65%, and new weighted average lending rate of the commercial banks at 11%, and weighted average deposit rates are around 7%. And also these easing monetary conditions have been reflected in the revival of private sector credit from the banking system, and we have seen a steady revival of private sector credit from the banking system from May onwards. And so far during this year, there has been a credit expansion of 300 billion rupees from the banking system. We have some preliminary information about December also. December also shows some revival in credit. December being a seasonal demand month also, relatively higher credit in December as well. So even though central bank has reduced policy interest rate notably and currently maintaining the accommodative policy stance, central bank is also mindful of other considerations like the need for maintaining external sector stability without easing the stance too much. Because we already see there are clear signs of robust growth recovery with the actually realized GDP numbers as well as the leading indicators for growth showing a steady revival of credit and also the economic activity. And the planned relaxation of motor vehicle also can create some higher import demand, and that can have some impact on the exchange rate as well as the external sector. And also the future movements of key commodities that the country is relying on for imports. So though some projections suggest that the crude oil price and all will be lower than last year, there are a lot of uncertainties on the geopolitical front. So we should be ready to face any external sector shocks. So central bank is mindful that overly accommodative monetary policy stance could exacerbate import demand at times of resumption of debt service payments, posing risk to the external sector stability. And also here we are showing the chart of inflation path as well as the index. Usually we see a different interpretation of inflation as the reduction in cost of living, but cost of living can be reflected by the change in index, So we can see that the index continuously being at elevated level after peaking in 2022. So we are not trying to say that cost of living has come down. What we are trying to say is inflation has come down, so the rate of price increases are currently negative. And the third section of this requirement, an estimated time period within which inflation target shall be achieved. So based on the currently available information and based on the forecast we have done for the last monetary policy cycle in November, we project that by third quarter of this year, inflation will come towards the targeted level. And it will stay around the targeted level since then. And this is the fan chart that we have produced in November. And currently we are in a cycle, and we will be publishing the revised fan chart next week after the announcement on the 29th. As per the current forecast that we have done in November, the inflation is expected to come back to the targeted level and stabilize around the targeted range over the medium term. And we have shown a red dot that shows the quarterly average for quarter 4, and which shows that that is in line with what we have projected earlier.
Thank you very much, Director Economic Research, for that comprehensive presentation on what you think are the reasons why you missed this target and what measures you plan to take. The first question I have, we have many questions, I'm sure. The first one I will ask you is, I mean, this whole supply side, like the member earlier mentioned, you're putting all the blame on the supply side, right? So then the question is, how effective is monetary policy, right? What is the transmission of monetary policy? How potent is monetary policy? Has it become important? For instance, now you are already seeing, your inflation, headline inflation, you said, minus something for quarter 4, and you're not seeing it going back up in the next couple of quarters. Now already you have dropped rates fairly to the, lower possible. So how much more can you drop rates to push price increases up? Yeah, so that's my point. So the tools that you have, obviously, is the tools that you have in your monetary policy toolkit. Yeah, on the monetary policy toolkit. So therefore, the question is, let's try to, dichotomize here the supply side and the demand side. And from what we see, the transmission mechanism is taking time, and potency of your monetary policy seem to be, fairly lame. So those are the two questions I have. Yes, please.
This is one question. What are the downside effects on the government? Because the government wanted 5% inflation, and I think there's a massive fall in the inflation. There has to be some downside to this impact, right? The inflation staying at 1% and below that also. So I'm sure this affects the production process and all of that. So, I mean, isn't this a problem for the government when we can't keep the inflation at the level that we want to keep it?
I think.
No. Let's get these three resolved, and then based on that we'll go for.
So I'll start with the I think last question, whether the negative inflation has an impact on the government. I think I would say negative inflation, positive, negative impact, we have to look at for the whole economy, not only for the government. So in that context, I think in our view, the negative inflation for a short period after very high inflation and very high level of prices, I think is positive for the economy. The reason being that if you look at this the level of prices from where we had the price levels in the economy before the crisis and where we are now, so price levels are still pretty much high and remaining at a certain level for a period now. But still, if you look at the kind of impact on the economy of this higher levels, I think it would be a concern for the economy if this deflation is going to retard the production that we are not seeing for time being. For example, from 2023 onwards, all the projections actually economy performed better than what was expected. For example, 2024 growth is going to be well above 5% compared to 3% what was projected. Even earlier it was lower but performed better. So I think maintaining a deflation or lower or stable price level is good for the economy if economy is performing at least above what we expected. Obviously, it's a concern if with the deflation, economy is also contracting, then obviously we have to push more to expand the economy. So I think in our view, I don't think we need to, there's no negative impact on the overall economy because of the deflation. It is I think, a kind of a relief for especially for people who are still not being able to catch up with what they have lost in terms of their affordability because of the high price levels. That obviously if you push further the higher levels with trying to achieve 5% inflation, that will have a negative impact on people's ability to spend in real terms. I think that's for a short period, that's good. Again, concern is that if that's prevail for a long period, obviously that's a concern. That's why we want to bring back to the inflation to a normal level over a period of time. That's why these policies are aimed at to bring that to a level what we think 5% is appropriate under normal economic conditions. And they are also, we all know monetary policy, what we do today will have impact on 12 to 18 months. So that's the time frame to have a full impact on the demand side. What we are basically controlling through interest rates is to maintain the aggregate demand at the right level. So when you look at current aggregate demand in terms of indicators, first one is the credit growth, credit moving into the economy is even now moving faster. Even the demand for imports, even at current levels of this interest rates, are basically moving higher. So which are indications of even that's where even co-inflation, which is the reflection of where the demand levels, moving well above 3%, close to the targets. See, all indications are still now demand is picking up more than what we thought. So that's why negative inflation is not a concern. I think now the concern should be, from our point of view, that's going to basically heat up the economy unnecessarily. We will see, for example, credit growth in December is better concern, close to, say 200 billion within the month is one of the highest credit expansion. And you can also see the queues in for imports. So imports are also picking up faster even without motor vehicles. So I don't think this deflation is good for the time being. And we need to control the overall aggregate demand. Supply side, obviously, this is headline inflation is reflection of mainly last year increase in value-added tax from 15 to 18%. Had one-off impact in January, but the second round impact was not as much as what we expected because still people's ability to spend at that point was much lower. So there was no demand picking up at that point. But now we see that has settled, but our assumption that there will be cost recovery pricing for utilities continuing. So we factored in that continuous price recovery of all the utilities. So but the changes happened in last year, that's why supply side factor mainly coming from energy and petroleum is the reduction was much more than what we expected. In fact, that is also a positive for the demand. For example, I don't think monetary policy need to kick in to push the demand. Reducing electricity, water, all these prices, reduced prices will certainly support more demand and will support more credit. And even this year, with the motor vehicle imports, I think this is without motor vehicle imports, credit is only picking up. With that, certainly if 1 billion value of motor vehicles are with 300 billion value of credit, at least 70% now on basic credit, this is another 200 billion credit in addition to what we see normal increase in credit. I think we are based on this current information, we are going to see inflation coming back clearly in the third quarter, could be even earlier, depending on the credit expansion. That's why we have to be very careful. We have to maintain the stability without jeopardizing the stability that we already, in a hard way, we gain that stability. But if you imbalance the stability, there's a risk of going back to, for example, excessive demand for credit, excessive demand for imports, without corresponding increase in foreign exchange earnings. There could be a short-term impact. So that we have to be very mindful. I think that's what, when you ask whether there's some more space for monetary policy, if you look at now, in my personal view, I think this is all depending on data-driven monetary policy. I don't see a further reduction of interest rates is risky. We certainly will I think this year also economy will grow at least 3.5%, which is not bad, actually good. Concern is that whether domestic economy is growing much faster with this kind of credit growth, and whether that will spill over to the reserves and the balance of payment. That will create another kind of a problem in the future. So we have to balance this. So that's why I think we should not push too much right now. That's my current basically view based on data now we have. And also we need to prepare for some kind of a shock. We don't know when the shock will be. Then we need to have some space in the monetary policy for us to react. And for example, if growth is coming lower than what we think, then we have an instrument to push it further. But right now it's other side. The risk what we see is other side.
Governor, you mentioned that it takes acclimatizes about 18 to 20 months. Yeah, so by the time you look at and react, it'll be 1.5 years later. So your job is, the independence is not to look at the vagaries. Your job is to ensure that you keep within. Because by the time you react, damage is done. Now my feeling is the currency is overappreciated, but that's why the inflationary force is not there. So I don't understand as to, it's not surviving for the moment. How you achieve the target is the question.
No, remember my submission here is that what your argument is that we should have had 5% inflation now, not negative inflation.
No, why do you agree with
that? Was the agreement with the finance minister?
Certainly, that was an agreement. That's why we have if you look at the inflation target, not only any country, you can't target today inflation by today policies. That's the reality. No central bank in the world. That's why monetary policy is a forward-looking policy.
Governor, can I follow?
Yeah.
So,
are you finished? Governor, are you finished?
Yeah, I finished. I think there's another follow-up.
No, just to flag, because you have missed the inflation target for 2 quarters, and inflation target is, we are not saying that 5% has to be the inflation target. This is a target that was set in 2023, but we just want to clarify whether you think the 5% target is a prudent target then.
It is.
And if then the question of why
5% is medium to long term on average basis. That's why quarterly average also. That's to measure the performance. We have this criteria, but it is appropriate from time to time. Inflation, I don't think any country its target is 2%. No country will ever maintain 2% all the time. It's 0%, 2%, 3%. Any country, that is how it is. That's how it is. But the bigger the target, higher the target, volatility is higher. So that we have to understand, because this kind of economy, headline inflation is largely driven by other factors like electricity price adjustment. That's not central bank activity. So if you want to push the inflation, if electricity prices are not adjusted, you could have seen the 5% inflation, headline inflation, but still underlying inflation is there. Underlying inflation is still about 3%. So, but problem is that we can't target underlying inflation, because that no one understands the underlying inflation.
Governor, but the very aspect of central bank is monetary. You can't
Exactly,
blame
yeah.
on fiscal. Now your excuses for non-attainment is you're putting it on the supply side and the fiscal.
If that is the reason, I don't think that-
Minister of Finance, the President, he'll love to reduce petrol prices, electricity, because that's the mandate he's getting.
Yeah.
So you can't be saying that is, you're four out of the lady that represented, 4 of the excuses that you say not achieving has been completely outside your monopoly.
Exactly.
So
That's
in
that's
that
why you
case,
explained.
now
this.
your next
So we can't
target
get
is-
into the
your
area
next
of
target is
someone
also
else's.
not achieved, and you're following it not achieved, then what's the purpose of independence?
Let me.
No, the independent and target achieved. I think I'm sure the honourable members understand. Independent central bank is implementing policy
If I
independence.
may ask the other way, non-achievement of it,
Yeah,
forget
non-achie-
independence, non-achievement of it, what is the purpose?
That's why we have this accountability and come and explain what are the reasons. If non-achievement is a reason beyond the central bank control, then we should have authority to control the other factors also. That I think you have to understand.
Let me intervene here, Honourable Member and Governor. You see, you went out to destroy demand, no? You had to do that. You increased interest rates by 700 basis points. And there was a lot of, negatives that happened because of that. People lost jobs, companies had to shut down. But from your perspective, in terms of controlling demand-driven inflation, you jacked up rates. Now we have brought the rates back down to some reasonable level. Now the issue is, Honourable Member Lakmali also, it is expectation of inflation that people are concerned about. Because inflation, what do I expect inflation to be for the next 12 months? So when I make an investment, if I'm getting a nominal return based on the expectation of inflation for that term, then what is my real return? Because at the end of the day, what we are concerned about is outside of inflation, the return, we get the real number. So there is a question there. If interest rates, like you said, is still hovering around 9%, and inflation is expected to be still, as the director mentioned, in the negative territory, you are saying real interest rates are 10%, right? That is a big concern, right? Because who can actually invest, from your perspective, Honourable Minister, to get a real return of 10%? So I would like an answer for that. But going beyond that, the question or the issue that we had previously was, now you said that credit demand is picking up. We all see that with the numbers. You said 200 billion in 1 month or something like that. That's massive. Huh?
It's in the stock market.
Maybe it's in the stock market. I don't know, right? That's a good, valid question. I want a probable response to that. Is now, then you said import demand is picking up even before you open the gates for vehicles. Now, what used to happen is the following, if I explain. Demand goes up, rupee depreciates. Government doesn't want the rupee to depreciate so much because imported costs go up, right? So they want to control the exchange rate. Then you release money from the reserves to the market. Then what happens is money supply goes up. When money supply goes up, what happens is money supply goes down because you're releasing dollars to the market, money supply goes down, interest rates go up. When interest rates go up, the government doesn't want interest rates to go up. Then what do? They print money back into the market. Then interest rates come down. You sterilize the impact. And this continues, and ultimately what happens is the rupee also depreciates, inflation goes up, and then, and the worst case scenario, we ended up with a massive crisis. So the independence we brought in specifically after this crisis to stop the central bank from doing that. We have taken away that punch bowl, as you used to say 20 years ago. Party is going, we withdraw the punch bowl, there is no more fun to be had at the party, if you get my gist. So therefore, there is no way that you can continue to buy government securities in the primary market. So therefore, we have controlled, restricted the independence of the central bank by actually doing that.
Review of the central bank last year also, I think inflation is mainly supply driven.
That's what I
Yeah.
mentioned last time also. Now, if you really look at what's going to happen, now as we speak, last week 30% drop in electricity rates. Government is going to push enormously to improve supply, right? Because we need to bring there was a chart nice that the cost of living has not come down, right? So it's going to be supply side activities for the next probably 3 years, I can say. Right? So then when you mention that it's going to come up to back to the normal side, the 3 near-term considerations, out of the 4 points, 3 points are fiscal. 1 point is monetary, that's the overlay accommodative monetary policy stance, right? So looks like the target that we all agreed, not only central bank, is not a practical target in the short term, maybe in the long run, right? So what is the effectiveness of us doing day-to-day activities on a target which is everybody knows it's not going to get achieved? One. Second question I have is, now if you really look at the development is the market interest rates, if you can go back to that slide, you see the margin between the bank rate and the lending rate during a particular period, right, that where the hyperinflation was there, banks were lending to people and adjusting interest rate at 30%, 29%, right? Now when things settle, it has brought down. So did the central bank lost its control during the period of May 22nd, 22 and 23, where the private banks went ahead and kind of bombarded the entire country, and the SME sector is 29% and now showing 20%, 25% profitability. Now where was central bank's role in that? Now there's a very close thin line now because your policy rate and the interest rates are very close to each other. Now when things are bad, the lending rates went up to skyrocketed. And was there any control in that period?
Just before you answer, Governor, there's a point I want to make, housekeeping point. Members, because we have two reports, no? One is based on 26.2, other one is based on 82. We can certainly sort of collapse both together and continue this discussion if you wish to, or else we can only consider the inflation target miss and then go to the other one.
Yeah, maybe then let's have that inflation target. I was asking the practicality of having
that comes in the second section of this discussion. Okay. If you want, if the members agree, I have no problem. Doesn't matter to
because it's the same question.
Yeah. So then in that case we are not having two, we'll just have one, and we can sort of bring in all these matters in this. Please go ahead.
Yeah, the first question, Honorable Chair, on what you asked, this real interest rates question is a valid one. So when we look at for monetary policy purposes, what we look at the real interest rates is in the forward-looking basis. When you work out real interest rates, current inflation and current interest rates is what we call real interest rates, what is happening currently. But usually for monetary policy, you look at what is expected inflation and then what is the interest rates. So expected inflation is that target is 5%, the interest rate is 8%, real rate is now 3%, which should be technically little higher than the growth. So that's a positive for the economy. But when the inflation moving in this volatile situation, real interests are obviously moving up and down significantly. If you look at the real interest rates, peak of the crisis 2022 is very, very high. But still, compared 70% inflation, but that is negative. So it's turning around. So that's why real interest rates always need to look at the forward-looking base, like the monetary policy. That's one question. Then the question on honorable members on the.
Almost 10% real interest rate.
That's what I say. Current, that is based on current inflation.
Yeah, but what the director showed us is that in the near term, inflation is going to be still in negative territory, right?
Yes. Now
so
then,
if the rates are,
fine.
say, let's 8%, we are still looking at 10%, 9% real interest rate.
Now the question here, whether these real interest rates are affecting the credit growth or economic activity. That's the outcome now. But we all intend the target is to have a balanced credit growth and recovering the economy. If that is not happening even under the current high real interest rates, then obviously there's a case for us to reduce further. But right now, as I said earlier, there's no suppression, no retard basically on the credit growth as well as economic recovery, even with this current negative high real interest rates. So if you want to bring it down further, by bringing down interest further, that will have an impact on the next 6 months, the inflation as well as the growth. So that's where I think real interest rates, high real interest rates are affecting growth, economic activity and credit. Obviously, we see that's a set for us to reduce further. As I said earlier, we don't see that right now. So that's obviously real interest rates. What we, as I said earlier, need to look at the forward-looking basis. That's why we make decision.
So
if we see economy is going to slow down, obviously then we have.
So are you saying that the real interest rates will fall to about 5% with your?
We will come down to 3%.
Because if your forecast is going back to 5% on inflation, and interest rates are sub double digit, say 9%, then you are looking at 4-5% real interest rate, which makes a lot of sense.
Basically, because there's a premium on the plus real interest, and the other question I don't remember this what happened in the past. I mean, you go back to interest rates, the cycle, please, Sujita. Earlier interest rate chart. This one, if you look at the policy rate, we tighten up to I think 16% maximum. I thought the policy rate, but the market rates, why that went up too high is there was a huge premium on uncertainty during that period. First one is the debt restructuring concern. When there was a concern on debt restructuring and uncertainty, especially government securities, yields, treasury bills in the market went to 33%. You know, a benchmark rate, the government is paying 33% and market is asking 33% to factor that risk of domestic debt restructuring, then all the market rates, no one can control that part. Then if you are to control, we should have pumped a lot of money and control. That's what we did some time ago. That could have been a disaster if we did that. So the adjustment here is that the sharp adjustment upward is mainly due to uncertainty in the domestic debt restructuring, and as a result, government securities went up to 33%. Then benchmark rates are government securities, and all the other rates are moving. Once we see the certainty and some settlement, then gradually that premium came down. That's how interest rate came down sharply after the settlement, and also much clearer outlook on the interest rates.
You know, I'll wait for the others to ask. You know, I don't necessarily agree with you on that particular point, because you know the restructuring of the domestic debt kept out banks and others, and you know, so the carrying cost of
that announcement made much later. This rates went up before that.
You know, rates went up. People expecting a fair cut, but some got cut, some didn't get cut. I mean, we don't need to go into that debate now.
You have asked
that's a different debate. But some people just got off scot-free. So that's not your point, and that's a government decision. I don't think it was your decision who to keep out, who to include in the restructure.
Was it?
I don't know. We had no idea.
This decision by the Parliament.
Well, don't put it on us.
So, domestic debt restructuring resolution was passed by the Parliament.
Who proposed it? Resolution was passed by Parliament. Sure, we had to do what we had to do in a matter of crisis. Whether we were in opposition or whether we were in government, Sri Lanka was. No. Let me tell you. Remember, Sri Lanka was first priority. We needed to rescue Sri Lanka. Whether we were in the government or the opposition, we did what we have to do. If there is blame to be put on us, go ahead and do it. I have no problem. But we had to take a decision at that time. We couldn't continue, without any end in sight. But it was proposed to Parliament. We had a long debate here, very, very animated one, and then we agreed. Let's not go back there. My point is, even then, we didn't agree that some people were left out of the restructuring. We didn't agree. Right? We went into the well of the house and we said we don't agree. But that's another matter. The government and they decided the opposition didn't agree. But that is in the past. But let's go on and continue with this debate, discussion.
Governor, on this basis, how do you see the comfort of the small and the medium? That's the backbone of our economy. And I can see that they are rumbling and grumbling a lot. And with the present position that has been taken, I don't think that they will get any benefit or any residual benefit will come to them for the next 12-15 months. How would they get this accelerated benefit coming to them?
From central bank point of view, what you all can do to bring down the interest rates in line with the normal economic circumstances. We are seeing, if you look at the market interest rates now, it has come down to a level that we had even before the crisis for everyone, including the prime lending, government, and also with the premiums of...
But Governor, realistically, the small and medium are borrowing at 16, 17, 15 to 17. They are average one. So they are not in the...
Sorry, I think I can show you the data, what's from the bank
So we are compiling a rate for SMEs also. So that rate peaked at new SME rate. That rate peaked at 26.9 in 2022, and that is currently at 11.85 weighted average rate.
Well, they meant you, no?
No, I think Honourable Minister, before you start, on a housekeeping matter, if anybody wants more tea, put your hand up, we can get more tea, water.